All right. Amortization of capitalized software costs. So, annual amortization on a product by product basis is the greater of these two. Now, like I said, generally we are going to use our nice straight line method, but there are other methods here. So, it's the greater of the total capitalized amount times basically the percentage of revenue, or the total capitalized amount times this is straight line. This is straight line. This is just as you would do straight line depreciation. Now, the question would have to tell you what the numbers are, what you would use. So current gross revenue of the period divided by total projected gross revenue. So this is like percentage of completion, essentially for construction. This is like units of production for depreciation. So if we make 25% of the gross revenue of the total projected gross revenue, this is 25%, would be amortized right away. Two different methods, but again, straight line is the way to go. All right, software created to be sold or licensed. This is inventory. So costs incurred to actually produce the product are product costs, and those are charged to inventory. Interesting. Capitalized software costs are reported at the lower of cost or market, where market is equal to net realizable value. Now, this is explored in depth in our inventory section, and if you have any doubt about that, please revisit that section, as well as the fair value measurements section. We've got a lot of wonderful lectures and comments there. Here is another wonderful graphic accounting for the costs here. Well, you have an idea. You're sitting in your Steve Jobs garage in your basement, and you say, wouldn't it be a great idea to mass produce fruit? And then after that, we'll call our computer company after the mass produced fruit. All right. So anything after the idea and before technological feasibility, as we've discussed, is expensed. Those are program, design, plan, coding, testing. Then after technological feasibility, we capitalize, like we talked about, producing product masters, including additional coding and testing. That's after the project is real and you have a real asset. And then once you reach the point where you release it for sale, this is where amortization expense begins. And now you can start recognizing inventory as cost of goods sold, or as rather inventory and cost of goods sold, right? This is where you duplicate packaging, you create multiple copies of it. There's just many more costs, and those are cost of goods sold in inventory. It's a product now.